Imagine you save up your whole life, hit retirement, pop the champagne, and then the stock market decides to absolutely crash the party within the first 2 years. That right there is sequence of returns risk, and it is one of the sneakiest threats your retirement money will ever face. Most people think if the market averages 7% over 30 years, they are going to be just fine, no matter when those gains show up. But the order in which you earn those gains or losses changes everything, and your retirement account does not care about your averages. Think of it like a buffet line where the good food keeps running out right when you show up hungry. If the market drops 40% in year 1 of your retirement, you are selling your investments at their worst possible price just to pay your bills. Here is the gut punch. Nobody talks about at the retirement party. You cannot earn back those early losses the same way a younger investor can. A 30-year-old can ride out a crash and wait for the recovery, but you at 65 are pulling money out every single month, no matter what. Let's say 2 people both retire with $500,000 and the same average return over 20 years. One person gets the bad years first, the other gets the good years first, and they end up with completely different amounts of money, even though the returns were identical on paper. The person who got hit hard early could run out of money a decade before the other one. And that is not a math trick, that is just the brutal reality of timing. We are talking about the difference between a comfortable retirement and calling your adult kids for help with the electric bill. Now here is where diversification rides in like the slightly nerdy but dependable friend we all need. Spreading your money across stocks, bonds, and other assets means when one thing crashes, something else might hold steady or even go up. Bonds, for example, have historically done okay when stocks are doing terribly, which gives your portfolio a little cushion, so you are not selling your worst assets at the worst time. It is not a perfect system, but it is like wearing a seatbelt. It does not prevent every accident, it just keeps the damage from being catastrophic. Your withdrawal strategy matters, just as much as what you are invested in. And this is where a lot of retirees accidentally make things worse. Pulling the same fixed dollar amount every year, regardless of market conditions, is like spending the same at the grocery store, whether you got a raise or a pay cut. A smarter move is something called a flexible withdrawal strategy, where you spend a little less in bad market years and a little more when things are going well. It sounds simple, but sticking to it emotionally when the market is down and you want to panic is genuinely one of the hardest things a retiree can do. Some people keep 1 to 2 years of living expenses in cash so they never have to sell investments during a downturn, which is called a cash buffer strategy. That way, when the market drops, you are buying time instead of selling shares and giving your portfolio a chance to breathe and recover. History actually backs this up because we have seen major crashes in 1973, 2000, 2008, and 2020, and every single time the market eventually came back. The problem was never the crash itself. The problem was people being forced to sell during the crash because they had no plan and no cushion. Planning for variability does not mean predicting the future. It means building a retirement that can survive a bad first chapter without falling apart entirely. You do not need a crystal ball. You need a strategy that accounts for the fact that markets will absolutely 100% do something unexpected at the worst possible time. The whole point is that retirement is not a finish line. It is a starting line for a 20 or 30-year financial marathon. Getting the first few miles wrong can cost you the whole race, which is why understanding this risk before you retire is so much more powerful than learning about it after. If any of this clicked for you or you want to go even deeper on retirement strategies and financial planning, go ahead and check out our links in the description.